Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
All right, welcome to a new year and another episode of Something More with Chris Boyd. Thanks for being with us. I'm Chris Boyd. I'm here with Jeff Perry and Russ Ball. We are of the AMR team, and the firm is Wealth Enhancement Group. So glad to have you joining us, and glad to talk about. Let's start by looking back and looking ahead this year. It is the time of year when people make resolutions, and one of them oftentimes is thinking about their financial life and all that goes into that. Maybe a little bit of their portfolio review, maybe reset their financial plan. We certainly can be a resource to you if you should have any needs along those lines. Don't hesitate to reach out to us. That's what we love to do. We're a resource for that kind of thing. So in any case, for those who are interested, you can connect with us by reaching out to our email, amr-info@wealthenhancement.com. We are regularly, we provide a complimentary consultation. We usually work in a two-step process where we like to take a look at getting to know you, get to know all your priorities, all your details, and then we follow up with a follow-up meeting to do some assessment, do some analysis, present what we found and how we would suggest you do things. So if that's something you're thinking this time of year you'd benefit from, don't hesitate to reach out to us. Again, that's amr-info@wealthenhancement.com or 866-771-8901. So guys, let's start by looking back and then looking ahead. I was thinking about performance data and looking at a couple of different articles that were talking about what's been happening with the performance of the markets. I'm sure you guys have some of this too. Anybody want to chime in with some of the data? The S&P 500 perhaps been another banner year, 2024.
Another banner year. 23.31% in 24 after a 24.2%, two back-to-backs, 20
So
pluses.
23 got 24 and 24 got 23, huh? Is that basically what it is? Yeah, that sounds pretty good.
A two-year gain of 53%.
That's kind of astounding.
That's
Of course,
the
it
best.
had been a down year the year before.
I know. Hey, I'm trying to celebrate.
Yeah, sorry. But no, that's pretty amazing.
That's the biggest gain. Biggest two-year gain since 1997.
It's amazing.
Yeah. It is after the pandemic and the, bad years for the stock and bond market in
2022, which was really driven by the Fed's jump in interest rates that took a toll on both stocks and bonds at that time because of the severity, the dramatic change in the nature of that. That being said, look, I think you got to celebrate. Like you said, it's exciting to have those kind of returns. It's naturally a time where you start thinking, well, can that continue? And you look to other periods of time, and although we tend to say, oh, the average is 2 years up, 1 year down, that kind of thing. It's not necessarily sequential that way.
It could be 1 year down, 2 years up.
Well, however, yeah, that's right. As you look at it, right. But you look to the 1990s, the 1980s and 90s. Really, they were prolonged periods of upswing and prolonged upswings. So it's not necessarily something where we have to be thinking, oh, the other shoe's going to drop, that kind of thing. But just while we're talking about it, do you want to? Anybody want to make any predictions? What do you think? What should we expect? I saw in the CNN article, they said Wall Street forecast reviewed by CNN show most strategists expect double-digit percentage growth for the S&P 500 in 2025,
That's not me. Not that
though
I was quoted in
more
CNN.
moderate than in 2024. Analysts expect, I'll just share this, S&P 500 to rise 14.8% in 2025, according to FactSet.
I'd love to know
right.
what they predicted for 2024, but I know you don't have that data. But
Yeah,
you know,
everyone upped their predictions as the year went
as
on.
they
Right?
go, right?
Yeah.
Well, Santa Claus didn't think we needed any more at the end of 24.
No.
Santa
Recent
rally.
theme, huh?
My wife believes in Santa Claus and the Santa Claus rally, and she got excited at the end of the year, like, "Oh, we're gonna get right
Nice
after
bump, huh?
Christmas." Yep,
Yeah.
and Santa Claus was very good all year, but he did not give us the rally. So, would you like my prediction?
I would.
I see Russ thinking about it, so I'll go first. I don't mind. First, I'll say something that didn't happen in 24, and that is that we did not have a correction, which is a
Yeah.
normal part of the market, 10%, broad based in the averages. So my first prediction is that we have a correction,
Yep.
and my end of year prediction for the S&P is 6,200 after the
Oh.
correction, 8% gain for the year. So I'm optimistic.
Yeah.
I'm not running to the hills.
I
But
think that's a realistic kind of a way to look at it. But that's good. So an 8% gain is your estimate.
I was going to start with 1,000-point gain, but that includes the 10% correction coming back from that. So
Yeah.
I think we're going to have, end of the year, 6,200 roughly, 8% gain, moderation, kind of sector rotations coming on, maybe value being more appreciated. Maybe the the high flying techs, AI stocks might have a neutral year, but at the end of it, when everything balances out, I think a modest gain of 8% after the correction is how I see it.
Well, I have a stat to share that's kind of in line with that. I read this morning that after 2 consecutive years of 20+% returns, the average was about 6.7% for the ensuing year. So it's pretty close.
That sounds in line with that kind of thing.
Thank you for the affirmation, Russ.
Yeah, there you go.
Excellent. That's interesting, and I think your point about a correction and so forth, I'm feeling in line with that. Of course, look, I would just start out by saying predictions like this are really of no value to anybody. It's fun to do.
I don't claim mine has any value.
Yeah, right. I mean, we're not, So that being said, I'm more cautious. I think we'll be just a little bit positive or a little bit negative when year end comes, and
floating through the year or with a correction and recovery.
No, I think there'll be. I think there'll be a downturn at some point. You look at we're a little overextended when it comes to PE multiples. What at 22 times or thereabouts? Maybe a little less than that today. I don't know where it is exactly today, but and we're recording, by the way, on January 2nd. And then when you look at the high prospects for a government showdown when it comes to the debt ceiling, been pushed off to March at this point.
Yep.
When you think about world events,
geopolitics, right?
Geopolitics.
Who knows?
I don't know. It would be surprising to me if we didn't have a correction, like you were saying. Last year we didn't, though we had a downturn of what was it, around 8% at some point during the year, but not a full 10% correction. I just think the likelihood is high that we'll have some disruptions and some volatility re-enter the experience, and I think it's probably likely we'll end the year a little bit positive, but I don't think it'll be another banner year. Put it that way.
You're not going to give us a number, huh?
For the I didn't put a calculation to it. I'll go 2% if that's helpful. 2% higher.
Okay, so you're 59.50 maybe.
All right. That's pretty pessimistic, I think, but at the same time, after you have a couple of years of banner numbers like we've had, it seems it'd be surprising to me that we just didn't have some sort of a slowdown a little bit.
I'm gonna go ahead, Russ. Sorry.
Yeah, I have another stat. So,
Okay.
only once has S&P had more than 2 years consecutive 20+%.
All right.
Gains. So, and I think it was in the 90s. So only one time ever of 3 years.
I'd be very happy to be wrong and have another record. I'm fine with that.
Absolutely. Well, let's talk about some other stats in terms of the year. Let me just see if I can find some of these details. I thought that I saw gold in the numbers, but let's look at the Treasury. Treasury had this wild fluctuation from yeah. Well, it just like at one point just a few months ago, we were down around 3.65 or something like that on the yield, and went up to about 4.65. It's come down a little bit off that, but it's around 4.5 maybe on the yield, somewhere thereabouts.
4.57, yeah.
4.57. So that with that, keep in mind as yields go higher, prices tend to fall. So you have some disruption in performance there. But the year started with the Treasury around 3.9 and ending higher. What else could we share as interesting stats? I'm just like sifting through this article. You got anything, Jeff, you want to share?
Well, it's my least favorite thing to talk about, but cryptocurrency, you have to give credit where credit is due, because we're critical when it's not there. Yeah. But cryptocurrency,
big returns,
specifically Bitcoin, had a heck of a year. Didn't have a heck of a year, had a heck of a couple months after the election. President Trump was reelected or elected, however you want to frame it. Yep. And his posture on policy is different than that of President Biden.
Well, and the expectation, he's been pretty critical of the SEC chair,
right?
Gensler, is it? I can't think of his name.
And he's leaving.
And he's going to get rid of him in a hurry,
right?
And put in someone who's more friendly to crypto, which crypto markets have been very excited about, and the prospects of the performance of crypto is pretty appealing from that perspective. I think that there was an interesting article in the Wall Street Journal yesterday about the topic of cryptocurrency and some of the changes that should be helpful to the outlook for digital currency.
Correct. And whether or not that's baked in, the efficient market theory, right? Is all this baked in, all the favorable stuff brought forward, which happens a lot in markets.
Yeah.
Are markets too overly optimistic in crypto or AI or, pick one, right?
Right.
Not long ago, I was thinking of this morning when I was thinking about what we talk about on the show, but for a period of time, electronic tokens, what was it? Those tokens that you bought of artwork or the original.
Yeah. NFTs.
Yeah. They were the rage.
Non-fungible tokens. Yeah.
They were the rage, and people were spending crazy money to, buy the original digital image. Or then we had this period of people buying real estate in the metaverse and paying ridiculous, that's an adjective that I'm choosing. Some may say investing for their future, right? Yes. Yeah. I have a cold, so excuse my coughing, but maybe my cold is affecting my word choice as well. But buying these things that are trendy and socially popular, and they last for a little while and then they just kind of disappear. So they're very speculative. And for me anyway, I still put cryptocurrency. It could change. I still put cryptocurrency in that highly speculative bucket.
Well, we would encourage people to treat it that way in their investing, if they should use crypto in some fashion. Some of the things that have changed over the year, we did see the introduction, I don't know if it was last year or even before that, but it was recent, that ETF access to crypto became more widely accessible. Similarly, we've seen platforms embrace the ability to provide, like brokerage platforms, start to begin to give acceptance to the idea that they're going to make it available to buy through a platform like a brokerage platform. Fidelity, I think, already does this.
They do.
Schwab, I think, is in the process of doing this. There might be others, but that makes it more widely accessible as opposed to having to go through a digital wallet and trying to find, which platform is legit, which ones, we saw the FXT. Was that the one that was the blew up with?
Sam.
Yeah, Sam Bankman-Fried. Yeah, fraud. Yeah.
Sorry, another slip.
Yeah. So in any case,
his name is Sam Bankfraud. I mean, if you say it quickly.
almost.
That's not original content. I stole it from Saturday Night Live, I think.
That's pretty funny. So anyway, but my point ultimately is that you're seeing this greater acceptance of and easier engagement. That also has helped the price go higher faster as more people have the opportunity to access this more readily through these various channels, ETFs and now brokerage platforms. So all these things kind of lead you to think, okay, maybe it's going to still have some involvement that's easy, as opposed to a regulatory environment that was very skeptical and made it more challenging and so forth.
A lot of the obstacles have been.
If you remove some of that regulatory, there's how will this be regulated? Where is it regulated? Is it a commodity?
What is it?
Is it a commodity like gold or silver or something? Is it a currency? Is it
not a currency? I'm sure it's not a currency.
So is it capital gains treated? Like all this.
Well, the IRS says it is now. You have to report your transactions. Yeah.
So you get my point that it just it's a challenging. It becomes more accepted, but there's still things that investors need to be mindful of being tuned into. But if you're going to be speculative, that is to say money you're willing to lose significant, have significant volatility, which could be attractive at times, but it could also be unattractive at times where you could, lose significant amounts in very short period of time. If you're willing to tolerate that kind of volatility, then that's how to think about these kind of investments.
Yeah.
So in any case, I didn't find the Bitcoin returns for last year.
I didn't find them.
But they were enormous.
They were phenomenal.
Hundreds of times, multiple. I think it was 500 times. It might have been even greater. We'll find it in just a minute. I'll look that up.
One sector of the economy that didn't have a great 24 is the real estate sector, whether it be perhaps stocks that you own in the real estate sector, or a REIT maybe, or you're looking at the value of your home depending on where you live. It was not a great year for real estate. So then that's, in my mind, you talk a lot about, Chris, about reversion to the mean, and I think real estate was affected. The first thing people say is it was higher interest rates, right? So that's relevant, certainly, but also we had such a boom years during the pandemic where so many people bought second homes or moved or did whatever they were going to do. I think a lot of that business was brought forward, and it was time for maybe a correction anyhow in the real estate market. Prices were going through the roof, building permits were through the roof, and so you throw on 7% 30-year mortgage rates on that, and it really.
Sorry, just I was incorrect. It was about 116%. It looks like Bitcoin specifically over a 1 year period.
Okay, still a great year, right?
But but that's amazing. That's doubled. So went from, I think, around, I want to say it was around 45,000 up to
95,
87 or something like that. Yeah. So in any case,
maybe it's a good time to trade in your Bitcoin and buy some real estate.
Yeah. So continue with your point about real estate, the reversion to the mean you were saying.
Yes, that's all. I think I was done with my comments basically, but I think several factors in addition to the real estate, the interest rate on mortgages, the market needed some time to breathe. Prices were getting out of hand, and people had handled, done what they were going to do. So builders were in full steam. And whenever that happens, if the market slows down, builders often get caught with a little bit of inventory, and that additional inventory slows down prices. So I think it's a normal thing, part of the market, part of the reversion to the mean. Just like stocks can't go up 30% a year forever, or
Right.
25% forever, house prices were going up double digits also for several years. That just puts people out of range, and would be buyers just, Russ, you've talked about this before. Would be buyers just say, I can't buy anything, right?
Yeah, yeah. I mean, I
So
think a lot of people in my age group, or at least peers that I talk to, are not even entertaining the possibility of buying a home right now. Just feeling like the prices are too high, like rates are too
Interest
high,
rates are higher.
and there's just not a ton of options in the market right now where they're looking to.
I would say that. I mean, what are interest rates on mortgages? Around 7%, something like
30
that,
it's 30 year around 7, give or take.
depending on credit and all that kind of
Yep.
stuff.
15, 6.5.
I don't think that's historically high. It's just we're so used to
Exactly. Yeah, that's
the
right.
very low, but that makes it challenging.
I saw
Prices, I would argue, are though
Yeah.
is more like historically high.
Yeah, yeah.
So them coming back, or at least the
Yeah,
percentage of
some
increase,
pullback.
people catch up. I saw a statistic last night that the average age of the first time home buyer is the highest it's ever been in the United States, and it's 39.
That's very
That's
interesting. Yeah,
that's goes right to Russ's comments, though. I mean,
yeah,
I bought my first house at 98, 24. You know,
yeah, yeah. I think,
and I thought I was overpaying. It was $100,000 at
yeah.
11%.
No, totally with yeah. I was a similar age. I think I was a little older, maybe 26 or 27, something like that. But um, yeah, um, I think it was a little easier. Well, the price was similar. It was like 125,000 for when we bought our first house. At the same time, our income was nil.
Of course, of course,
So,
but it worked. The math worked.
yeah,
You could buy it was a ranch. We bought a 2-bedroom ranch, and it was great for us in Plymouth, actually, and we could afford it.
yeah,
I
and,
don't think
and it brings you to the whole thing about student debt and all these
all of it,
variables that go
right?
into it.
All of
Yeah,
it,
health
inflation.
insurance costs and so forth. All these related considerations. But I think it's we get back to this notion that there was a supply problem, if you will, in the
Right.
housing,
COVID.
and prices went up dramatically. People didn't want to give up their low interest rates. That's going to continue to create a lag on supply
Right.
for a while, and I think that's probably going to be the case for a while still.
Supply is so
So,
regional, though. Like in
yeah,
Florida, where I am,
where there's a
and they're
lot more
building,
vision, probably. Yeah,
the supply is up because these builders were, they have staff. They're building, and
yeah,
3 years ago, 2 years ago, you couldn't buy a inventory home because they were so behind the building homes that people wanted. Now you can, in certain parts of the state, you can buy an inventory home at a price that it was substantially less a couple of years ago. So
yeah.
depends where you are. If you're in Cape Cod, where you gentlemen are, there's not a lot of building going on, so that's not impacting the real estate market, I would think.
It's a good point. So, I mean, I guess as investors, you got to be thinking about these kinds of back and forth and so forth. Was I think where you were going with that, Jeff? The the pullback per se, or whatever, that prices seem to have had a little bit of a decline.
Yeah, I'm just
Um,
in my head comparing like your often comment about reversion to the mean, and
yeah,
it's normal. Markets go up, they go down. Um,
yeah,
That's why you have a financial plan. That's why you review your plan. That's why you talk to your advisor, so you don't get swept away in whatever sector that's getting your attention. In the temporary situation, you have a longer term vision and a
Yeah.
plan to get you where you want to be.
Yeah, good point. Good point. It does, and it does bring us to this bigger question that we won't deal with today, but this this ongoing challenge as a society that we face the question of how do we deal with the fact that there's some inequity in terms of people with lesser resources have lesser ability to acquire a home, as an example, whereas people who have wealth have greater ability to continue to grow their wealth. And so it really becomes essential for every investor, to every person, to be thinking in terms of that they need to have the ability to be in a position where they can live below their means, so that they can accumulate some resources to be part of the wealth class and not just part of the wage class. Because if you're only in the wage class, you're not participating as fully in the opportunities of the way our society seems to be working.
And part of that is the
not easy
government.
to do,
Part of that's the government, but part of it's you as a person. I think that's what you're saying, right?
Yeah. It's partly one has to strive to cultivate that little bit extra to invest, whether it's in your work plan or whether it's like a 401k or whether it's in your own savings and investment. Outside of that, one thing that's interesting I will add to our conversation just before we look to kind of wind down was how ETFs, we talked about this not long ago, that ETFs have taken on greater participation in the choice of selection of how people choose to invest. 30% growth in the use of ETFs last year, bringing the investment in ETFs to $10 trillion last year. Pretty significant. That's U.S. ETF, U.S.-based stock exposure.
And as we talked before, some or a lot of that money is coming out of mutual funds, I assume.
Yeah, it is, and I think it's interesting too that we talked about this, that a lot of this tends to be index based.
Mm-hmm.
I saw some interesting stuff from Jeff Patak. We should probably see if we can get him back. He was talking about how active managed, who's a Morningstar person, and he was talking about actively managed, how they're not really all that different in terms of that top heavy exposure to the Mag 7 or the top 10 holdings tend to be a lot of the same heavy weight that indexes have. It's not as different that as you might expect,
but it's grown quite a bit.
Yeah. Did you see some of this too?
Was it 40% of the Mag 7 make up the S&P? That's off the top of my head.
I think it's even. I think it might even be more, but I don't remember now. But yeah, and then this was interesting that his kind of point was that if you're thinking active management, it's getting you a broader diversification, or it's not as different as you might envision. Mm-hmm. And I think that's maybe an important opportunity for managers to be recognizing or thinking about if they're really going to provide active management and benefit to maybe somehow differentiate from the index.
Excellent point.
Yeah. Anyway, interesting stuff. When it comes to the year ahead, lots to think about. Whether markets will go up or go down. The issue for most investors is to be a long-term investor. We don't know whether markets will go higher or go lower in a given year. It's all, prognosticating. It's just take it with a grain of salt. Really, the reality is we want to be invested for the long term. Mm-hmm. Because we want to participate when markets go up, and we don't know from one moment to the next whether we're positioned to go higher or go lower. We can all have an opinion, but that doesn't necessarily define what the market will do. And I think the big picture is We can be modestly tactical here and there to try to adjust our allocation, but we might either miss out or take on too much risk or whatever it may be if we try to be too active in that tactical get me in, get me out kind of mindset. So the best thing to do ultimately is to have a long-term view, find the allocation that's a good fit, be invested in that allocation, and some modest adjustments about which sectors represent opportunity,
Right.
where there's opportunity within the market, how to be structured within the market, where you have participation, but you're going to ultimately benefit by the longer term directional movements of exposure to the market, which over time, if we expect the economy to continue to grow, we would expect to benefit from. Now, if we find, that we really do have, as an example, mass deportation or dramatic tariff increases, some of the things that people worry about in the what's been articulated with the political perspective, often what drives a lot of our listeners to have anxiety. If those things do actually materialize, then we want to maybe position a little bit more defensively to say, oh, how do we position for these kind of things? But there's a big difference in rhetoric and application of policy, right? So
Sure.
let's see how things develop, see how things go, because there's also the potential for less taxes when it comes to corporate taxes being lower rates extended, and
Less regulation,
all these things that would benefit businesses as well. So you really have to be a measured kind of approach and see how we do. Anything to add?
It's going to be another interesting year.
It sure will. All right. Well, with that, everybody, if we can be a resource to you as you think about your own planning, don't hesitate to reach out. You can connect with us. And as I said, an opportunity for a financial planning and portfolio management. We offer a complimentary consultation and would love to talk to you along the way. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.